if you have been keen to move to direct plans of mutual funds from regular plan, or if you've been dragging your feet about how to go about doing this, or you really never knew the benefits of direct plan, then you should watch this video. So, for those of you who really don't know the benefit of moving into direct plan, here's some simple data that mutual fund regulator SEBI has put out recently in a mutual fund consultation paper. The data basically says that the proportion of funds underperforming a benchmark, if it's equity and equity benchmark, a debt benchmark, is significantly higher under the regular plan as opposed to the direct plan. For example, in the data here that I'm showing you, over a 10-year period, 60% of funds underperformed benchmark, whereas under the direct plan, 33 or 34% of funds underperform the benchmark, right? Why is this so? I mean, it's the same set of funds, right? Just one is regular, one is direct. Fact is that the costs are significantly lower under the direct plan, and because of lower cost, over a period of time, as returns keep compounding, the chances of you beating the benchmark is higher under the direct plan, while it is not so under the regular plan, especially when benchmark themselves have become very competitive for funds to beat, right? So this is the fact that SEBI has put out. So your chances of beating benchmark is so low, there's just a 1 in 3 chance you will beat benchmark under the regular plan. There's a 2 in 3 chance that you will beat the benchmark under the direct plan. So this is a strong enough reason, right? And this happens because of cost. And what really is the cost difference? I just taken a simple example from our expense ratio tool available in PrimeInvestor's website for free. You can look under the tools section. I've taken the FlexiCap category average under the regular plan and the average under the direct plan. You will see the difference between the regular and the direct average for the FlexiCap category is 1.22%, right? Let's take an example of how this translates into returns. I've just taken a relatively new fund house, Navi FlexiCap, which comes here in this list of those with significantly higher difference. 1 year returns is 25.6 under the direct plan and 23.3 under the regular plan, right? So this difference is what really compounds over time for you and drags returns without you knowing about it. Because if you didn't know that direct plans existed, or if you never moved to direct plans, then the chances of you losing out on such returns is very high. So let's now move to knowing how to go about doing this switch. So you can do this switch directly through the AMC website. Simply, registering online and using the switch option. It's possible for you to switch from, just like you switch from, a liquid fund in a certain, AMC to a equity fund. You can switch from regular plan to direct plan, right? This is possible if you have just few folios or few funds. Then there are online platforms which allow you to move all your folios in various mutual fund schemes into direct. They fetch it for you, getting your permission online, and show you the funds and show you the units, and you can decide which ones to switch to direct plan. Then there's a traditional offline mode where you fill a switch form and then you can switch it. But that's again tedious if you have too many funds. The other is exiting fully and then reinvesting. But here, when you once bring money into your bank account, there is always a chance that you might spend it, or it may just dissipate, or you may delay investing and therefore have some market timing risk. So that should be your last option, unless you're having like one or two funds that can be easily done. The next thing is, most people ask this question: when I do this switch, can I just switch the entire amount as lump sum, or should I be systematically? You don't need to really do a systematic, transfer, simply because when you are already invested, all that you're doing is moving from A plan to B plan. It does not matter that you will be moving to a new date of investment. Your original investment is what really counts. Your original date of investment for your returns is what really counts. So there is no market timing risk. For example, you move to direct plan and then the fund falls. It would have fallen anyway, whether you had moved been in regular or indirect, right? So there is no market timing risk if you had already been invested in a certain scheme, right? You are simply making a move from regular to direct without really changing the timing of your entire investing pattern, right? So remember that. So you don't need to really be doing this. I mean, systematic transfer. The other very important aspect, and which is where people really worry, is the tax. First, let's understand what happens when you switch. A switch is considered a redemption. It's considered a transfer according to income tax. It's considered a sale of units. So it is taxed like any other redemption. That means your equity funds and equity oriented funds will have equity taxation, and your debt and conservative hybrid and all this will have debt taxation. And your date of investment on indirect will be the new date in which you make the switch into, right? So the day you purchase the direct plan will be the date of your investment. So the earlier transaction will be considered a sale and taxes will apply. Now this is the sore point for most of us who hesitate to move from regular to direct. Let us see how we can reduce the impact of such a switch on the taxation aspect. First, let's understand that if you're already running SIPs, it's important that you stop all the SIPs in your regular schemes, which means you cancel the mandate, right? Otherwise, you might have switched and you might still be having the SIPs running in the old scheme under the regular plan. Next, make a list of funds. In terms of, you'll have your reports in your already existing. See what is crossed 1 year, long term capital gains or short term capital gains. In case of debt, if you had purchased it before April 1st, 2023, whether they have crossed 3 years or they are less than 3 years, right? These are tax aspects. You can read about it separately. The fact is, you have to classify whether they are STCG or LTCG and whether you have any exit load or not. Right? This is very important. But please understand, there are some platforms, when they fetch this detail, they actually show it to you. Right? So you don't have to do the homework. But if you are, going to do it through AMC, etc., then you maintain an Excel sheet and first jot this down so that you know what you can switch right away and what you can delay. Now, the first thing in this switching business is, if you have poor performing funds, use this opportunity to exit and reinvest in different funds. Don't try to switch the same fund from regular to direct when it's already a poor performing fund. To that extent, it's okay that you exit, you put the money in your bank account and you reinvest them immediately. So just keep that in mind. Now, for equity funds, make sure you first switch funds that have crossed a year. The reason is that they will get LTCG benefit, so your tax, will be much lower, right? So, if you have X units and only half of them have crossed a year, just make that switch initially. You don't need to, especially when the amount is high. If the amount is small, running into some thousands or just a few lakhs, it is okay. The other important thing is, in capital gains, you know that you have exemption up to 1 lakh of capital gains. So see, if your investment is not very huge, you can straddle it, do it in a phased manner over a few years also. There's no harm, because if your investment horizon is 20 years, you could do this over 3 4 years. It's not a big deal. So if you can actually use that 1 lakh limit and do the slow transfer, but make all the new investments, because you have stopped SIPs here, make all the new investments under the direct plan, under the direct plan platform or the direct AMC that you're using. So just keep that in mind. The other thing is, with this is with equity. With debt, if you had invested in debt before 1st April 2023, then check whether they have crossed 3 years for long term capital gain. You can transfer those so that you at least get some indexation benefit. For investments made post 1st April 2023, the distinction is now lost. There is no STCG, LTCG, they're all taxed alike. So, which means you don't really get any benefit out of, waiting. So, you can still go ahead and make the transfer in a phased manner so that in a single year you don't have to pay heavy taxes. This calculation will be necessary for you to do. You can either do it yourself, um, plus like I said, some platforms actually show you how much tax there will be, or you can ask your auditor to do this as a one time exercise. It's not too difficult. Rather than postpone it, you might as well do it now and see how the tax burden is, so that you can spread it over a few years. And please remember, switches can be done only in the same scheme. You can't like just decide to switch from, from an SBI fund to, say, Aditya Birla fund, etc. So that's not possible. And it's the same scheme also. If you hold, some, say, UTI Nifty 50 fund under regular, you're going to move to UTI Nifty 50 fund under direct, right? So that's the idea. Like I said, if you have bad funds, you please exit them. Exit them, and or if you have any fund within the same fund house that you wish to switch to, you can do that. But it's easier done this way. Just move the same scheme from regular to direct. Schemes that you don't want to hold any longer, exit and reinvest. Now, the biggest thing is when your corpus runs into several crores, right? And you are in a platform, an online platform that is otherwise good, it is not a bad idea for you to continue this corpus, because the tax you will shell out will be so high, especially if you're closer to your retirement, like 7 8 years from your retirement. Hold those regular plans, and if you have still fresh investments, make them in this direct plan in a new platform. And once you retire, you need an income phase, you're going to start withdrawing from this regular plan first, so that you don't pay tax now at the time of switch, and in another 7 8 years you're going to pay tax when you're taking them out for your income needs. So that is one way of approaching. There is While there is definitely cost saving in switching, but if you are going to withdraw the money in a few years, you don't need to take the trouble of switching. Hold on to them. Otherwise, make the switch in a very phased manner, thereby knowing what cash outflow you will have. Please understand, there is no escaping this tax. If your wealth is not very high, then you can try and take benefit from this 1 lakh per year capital gain exemption. But if it is large, you can see how much you can reduce your tax burden every year, so that you don't move to the next tax slab. I mean, especially with your total short-term capital gain, they're added to your total income, etc. So just take care of that. And for those who continue to hold because their corpus is very high, maybe you can, we don't know, someday maybe the switch, right now there is no way, but someday the switch may even be not considered as taxes for I mean, as capital gains for tax purpose. If that happens, well and good, but until such time, this is the approach that you can take. Don't procrastinate, because as you procrastinate, it gets even more complicated, because more and more money goes into your regular plan. So the first you can do is start making fresh investments under the direct plan. Even if you're going to make these switches later, stop all the mandates for SIPs and start mandate under the direct platform, direct investing platform, and do the switch in a more phased manner. As for once you go direct, obviously you're on your own, and that is where a platform like PrimeInvestor comes into help. You will be able to get recommendations, not worrying whether you're paying high commission or not. And you can rely on PrimeInvestor to give you fund recommendations, give you alerts on when to invest, what the market is doing, what the rate cycles are, and when to move, etc. So do keep tab of that by subscribing to PrimeInvestor if you already haven't, and see if you can make a start today in terms of moving direct.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.